This is Nightly Business Report with Sue Herrera and Bill Griffin.
Dramatic comeback. Stocks stage a furious rally. The Dow reversing nearly 600 points, and the S&P 500 had its biggest comeback of the year. The rate debate. Today's initial sell-off came as bond yields continued to fall. Historically, falling rates are good for stocks, but could this time be different? And hiding in plain sight, you know your laptop or computer could be hacked, but what about the monitor or your office phone? The everyday things in the workplace that are vulnerable to attack. Those stories and much more tonight on Nightly Business Report for Wednesday, August 7th. Good evening, everyone, and welcome. Bill has the evening off. You can call this Wild Wednesday. It started with a trio of central banks cutting interest rates, and that led to a sharp drop in bond yields, highlighting the concern over trade tensions between the U.S. and China. That, in turn, led to a flight to safety. Investors piled into things like government bonds and gold. In fact, gold traded above $1,500 an ounce for the first time in 6 years. Stocks sold off, the Dow down nearly 600 points early on. Oil also sold off, falling more than 4%. But then the buyers stepped in and stocks reversed course. The Dow finished down only 22 points to 26,007. The Nasdaq rose 29 and the S&P climbed 2. The index's 2% reversal was its biggest comeback of 2019. Bob Pisani has more.
It was another wild day on Wall Street. The Dow plunging almost 600 points early on before rebounding to end essentially flat on the day. It was one of the great comebacks of the year. Mounting trade tensions have heightened fears of a possible global recession. That's put more pressure on central banks, including our own Federal Reserve, to keep cutting interest rates to get ahead of a sharper downturn. There were just several aggressive rate cuts announced overnight by central banks in Thailand, in New Zealand, and in India. That's why bond yields are plunging across the globe, with yields on Japanese and German bonds falling deeper into negative territory. Yield on the U.S. 10-year Treasury note falling to a nearly 3-year low early in the trading session. So no surprise that bank stocks like J.P. Morgan, Goldman Sachs, and Comerica sold off today as lower rates put pressure on bank profits. But stocks bounced off the day's lows right when the yield on the U.S. 10-year came off of its lows in the middle of the day. The two traded in tandem all day long. Despite the strong rebound in consumer staples and tech stocks, the more trade-sensitive industrials didn't budge much. Emerson, 3M, Caterpillar all underperformed today. In fact, since the start of August, when additional tariffs were announced, industrials, energy, semiconductors, they've all lagged the broader market. No surprise there. What do these groups have in common? Those are the global sectors most exposed to trade overall. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
As Bob mentioned, those cuts by those central banks, along with falling rates, puts our Federal Reserve back in the spotlight. Steve Leisman takes a look at whether the Fed is under even more pressure now to cut rates.
Normally, the central banks in Thailand, New Zealand, and India would not be seen as big global movers and shakers, not like the Fed, the ECB, and the Bank of Japan. That wasn't the case today when those three central banks sent a signal heard around the world as they cut interest rates either unexpectedly in the case of Thailand or more than expected in the cases of India and New Zealand. That was part of what sent global bond yields careening downward, eventually taking stocks with them for most of the day. The message to markets, the possibility that we're in the middle of a race to the bottom on interest rates around the world. In fact, President Trump even encouraged it today. He tweeted out today, "Our problem is a Federal Reserve that is too proud to admit their mistake of acting too fast and tightening too much, and that I was right. They must cut rates bigger and faster. It would be much easier if the Fed understood, which they don't, that we're competing against other countries, all of whom want to do well at our expense." Whatever their motivations, central banks around the world, from Russia to Australia to Brazil, have been cutting rates and doing so since at least April. Here in the United States, markets expect further rate cuts from the Federal Reserve. Futures markets trade with a 100% probability of a September rate cut, another quarter point expected in October, and even a third one expected in December. The Fed knows it can't maintain rates that are so far from other countries. The problem may be that if it cuts, other banks will simply cut more. For Nightly Business Report, I'm Steve Leisman.
Now, the upside to lower rates, mortgage applications, they surged last week. But as Diana Olick explains, not everyone is reacting to these new low rates.
Thank you for calling.
Homeowners didn't waste any time last week calling their lenders to refinance. Mortgage applications to refi jumped 12% for the week and were up a whopping 116% compared with the same week 1 year ago. This as the average rate on the 30-year fixed dropped precipitously to the lowest level since November of 2016, all thanks to the escalating trade war with China. The rate was nearly a full percentage point higher 1 year ago. That means more than 8 million borrowers today could benefit from a refi by lowering their rates at least 1/4 percentage point. That translates into a savings of about $150 a month on a $300,000 loan.
A lot of people will take those lower mortgage payments and say, oh, I wanted to fix up my kitchen or the bathroom or the garage or do a little bit of landscaping. So yeah, it helps to juice up home improvement, renovation, but also all kinds of spending.
Thanks so much.
Home buyers, however, were not impressed. Mortgage applications to purchase a home fell 2% for the week. That's the 4th straight week of declines, despite lower interest rates. Purchase applications were nearly 7% higher than a year ago. Mortgage rates continue to fall this week, so you can expect to see more borrowers rushing to refi. As for buyers, it's just more complicated. Low rates certainly help to afford a home, but the reason rates are low, that is, fear about the strength of the economy, makes buyers nervous and less likely to want to make such a huge investment. For Nightly Business Report, I'm Diana Olick in Washington.
Over the past week or so, the market has generally been lower since President Trump said the U.S. would impose new tariffs on Chinese goods beginning September 1st. Our Eamon Javers asked the president today if he was surprised by the market's reaction.
The market reaction is to be expected. I might have expected even more. At some point, as I just said, we have to take on China. China is losing they're losing thousands and thousands of companies are leaving China now because of the tariffs. And we're in a very good position as to whether or not a deal will be made. I will tell you this, China would like to make a deal very badly.
Now, many of the central banks are reacting to concerns about slower global growth because of those trade tensions between the U.S. and China. It was exacerbated Monday when China's yuan, its currency, hit its lowest level against the dollar in a decade. But since then, China has worked to stabilize the currency. And as Yuan tells us, today was no different.
Beijing is sending the signal that if there is a currency war, it won't be because of China. The authorities here today were intervening and managing the markets in order to hold up the value of the currency. First thing this morning in the mainland Chinese markets, the People's Bank of China set what it calls the midpoint at 6.9996 to the U.S. dollar, just stronger than 7. The way the system works here is that the central bank fixes the value of the start of trade every day to influence trading. Currency traders were also talking about reports that Chinese state banks were stepping into the markets, both here in China and offshore, to support the renminbi. And this is another standard way that the government tries to manage the currency's value. The move follows a statement yesterday by the central bank vice governor that China believes it is responsible to keep the yuan stable. There's been a lot of debate about what motivated the Chinese to allow the yuan to weaken past 7 earlier this week, but it's becoming clear day by day that the Chinese government wants to make sure that the currency stays under control. For Nightly Business Reports, I'm Yuan in Beijing.
And the important relationship here is, of course, with the U.S. dollar. More precisely, the relative strength of the dollar. And that is incredibly important for U.S. companies and markets. Think Caterpillar, ExxonMobil, Coca-Cola, or 3M. They're all U.S. companies that do lots of business overseas. If you're invested in multinationals, pay attention to the U.S. dollar. The stronger the dollar gets, the more of a country's currency it takes to buy products that are sold in dollars. With prices up, it figures that fewer American products are likely to be sold in China and elsewhere. And some U.S. products, even oil, are facing tariffs, and that drives up the price even more. So one question investors have to ask, will higher prices allow a company to offset the fact that it's selling fewer goods? If not, profits are reduced. And the inverse is also true. For example, China's exports become cheaper to buy here, which reduces the impact of any tariffs the U.S. might place on those goods. So now the question is, how much of an impact is a strong dollar having on those multinationals? Seema Modi takes a look.
President Trump may want a weaker dollar, but with a record number of central banks cutting rates around the world in 2019, that's going to be a harder objective to achieve. Wall Street strategists are now betting that a stronger dollar will likely become a bigger pain for companies that make a large portion of their sales overseas, like consumer staples sector, which on average makes about 45% of their revenue outside the U.S. Analysts caution that if the dollar continues to strengthen, it could make American products less attractive to customers overseas, especially in emerging markets where the consumer tends to be more price sensitive. Multinationals could bring down the price of their products, but that could then impact profitability. In the first quarter, North American companies lost more than $23 billion due to the impact of currencies, the most in more than 3 years. And analysts say that number will likely go up in the second quarter. So far this earnings season, internationally exposed names like Kimberly-Clark, Procter & Gamble, General Mills have all cited the negative effect of currencies. But their stocks have held up well, in fact, outperforming the broader market in 2019. Investors say much of that has to do with these companies' appealing dividend yields.
Dividend-paying names tend to be a little bit less volatile than the market, and they do offer stability in this type of situation. And just look for company-specific stories.
With central banks becoming more accommodative, Invesco says it's making higher dividend-yielding multinationals, specifically in the consumer staple space, more attractive. But that can change if a stronger dollar continues to eat into profits. For Nightly Business Report, Seema Modi.
So joining us now to put all of this into perspective is Andres Garcia Amaya. He is the founder and CEO of his own wealth management firm, Zoe Financial. Andres, nice to have you back.
Thanks for having me.
We posed the question at the beginning and the premise that when rates are falling, it's usually positive for stocks. But you have rates falling all over the globe and actually negative rates in many countries around the world. So is it different this time?
So when rates are falling and the global economy is doing fine or global growth is accelerating, I would agree that that's usually a positive thing. When rates are falling like the way that they have the last couple of days as a result of people basically looking at the geopolitical situation and seeing the tensions escalate, that's a different story, right? That is essentially people looking for a safe haven and therefore buying treasury bonds as a result of that treasury yields falling. For that, usually that's not a positive for equities.
Right. So what is an investor to do at this point if it looks indeed as if we're going to continue to see these lower rates, maybe negative rates in more parts of the globe? Is the safe haven status of the U.S. still the place to be?
So I think what we learned the last couple of days is that all of our crystal balls are broken, right? We didn't know what was going to happen 2 weeks ago, and now we clearly know, I think everyone knows, that we didn't know this was going to happen, especially with the trade wars turning into currency wars. So I think what this reminds us is that equity markets tend to be more volatile. If anything, this year, they've been pretty calm, and the volatility we've seen is actually more normal than we've seen in prior weeks. That's one. And two is that you should have a personal financial plan that you should be pulling up right now and checking to see if anything has changed over the last 2 weeks. If nothing has changed with that personal financial plan, then your long-term investment objectives should not change with the geopolitical tensions.
But does that include then riding out increased volatility? Do you need to adjust that financial plan if indeed you think we're going to have more volatility ahead?
So volatility, when you're buying equity, volatility if you're a long-term investor actually is to your benefit because you're not trying to retire tomorrow, right? If you're thinking 5, 10 years out, short-term volatility is what allows you to have higher expected returns on those equity stocks versus on the bond side.
So what do you do now? If you have an overall investment plan, and we just highlighted the multinationals, many of which have fairly decent dividends, do you take the opportunity on a day like this when we at one point saw the Dow down 600 points and add to a position? Is that the best safe haven at this point?
So this is something people rarely say, but days like today do nothing, right? When people make decisions based on emotion, based on what they see on the headlines, usually in the long term, that ends up not being the right choice. So if you don't have a personal financial plan, I would say that's the actionable item: is get a personal financial plan to ensure that these kind of short-term volatility doesn't dissuade you from your long-term objectives.
So if you want to be in equities longer term, What areas are you seeing value in now, and areas that perhaps might give you a little bit of safety or at least reduced volatility?
So the best way to think about it is if you had a strategy in which you say that you wanted 70% equities and 30% bonds, and the market falls 5-6%, that should trigger a rebalancing automatically to buy more equities without any kind of emotional decision attached to it, right? So use those benchmarks that you set for yourself and use them wisely when the market gives you the opportunity to get you back to where you should have been in the first place.
A quick comment on the gold market. We mentioned the fact that it hits highs that we have not seen in several years. Would you hedge your equity position in gold or not?
I would not. Gold is one of those asset classes that I personally do not understand what it does and when it does it. And if I can't explain it, it's very hard then to explain to the client why we owned it in the first place, right? It seems to be right now is a good hedge against essentially more volatility in the equity market. Sometimes it does that, sometimes it doesn't. Right, so I personally don't see it as a great hedge to volatility in the short term or the long term.
All right, on that note, thanks for the advice, Andreas. Good to see you again.
Thanks for having me.
Andreas Garcia Amaya with Zoe Financial. Coming up next, Disney was one of the biggest drags on the Dow today following its earnings miss last night. Hear what the CEO says the company is doing to succeed in the future. And there's a look at the shares of Disney, the stock down about 5% following the company's earnings, which we told you about last night. That miss was attributed in part to Disney building its streaming business. Julia Borston sat down exclusively with Disney CEO Bob Iger to talk about the company's strategy.
Disney CEO Bob Iger is saying this quarter's lower than expected results reflect the cost of the company's transformation as it integrates Fox and prepares to launch Disney Plus, the centerpiece of its streaming business. With cord cutting continuing to weigh on Disney's media networks business, as well as all the pay TV providers such as AT&T, I asked Iger how concerned he is about projections that cord cutting will only accelerate.
Are we concerned about cord cutting? Yes, that's been an important business for us. But it's the reason why we're going into this other space, why we're pivoting strategically to give us an opportunity not only contend with the transformation that's going on in the traditional space, but to thrive in basically completely different marketplace conditions.
Iger says the company is investing to succeed in the streaming wars, announcing that Disney will sell a bundle of Disney Plus, ESPN Plus, and Hulu with ads for $12.99, a $5 discount.
Our goal all along was to achieve scale, particularly with Disney Plus, as soon as possible, to basically sign up as many subscribers as possible and get them into the service, giving them a chance to enjoy the great intellectual property and the product that will be part of that service. And we thought that this bundle would be a great step in the direction of achieving that goal.
It's not just about the subscription revenue Disney will earn from those services. Iger telling me that getting a broader audience for Hulu will help grow its ad revenue, which he says is a valuable revenue stream. For Nightly Business Report, I'm Julia Borston in Los Angeles.
The New York Times sees a rise in digital subscriptions, and that's where we begin tonight's market focus. The company reported mixed results, beating earnings expectations but missing on revenue. The Times says it's making strides in its digital subscriptions, but expects what it says is a challenging second half of the year with its digital advertising unit. Shares fell more than 12% to $31.25. CVS topped estimates thanks to an increase in same-store sales, prescription drug sales, and its recent acquisition of the insurer Aetna. The company also raised its full-year outlook. The stock rose more than 7% to $58.12. CVS rival Walgreens will shut down about 200 stores, or 3% of its U.S. locations, as part of its plan to cut costs. The company says it will deliver annual savings of more than $1.5 billion by 2022. The stock was up 2% to $52.48. Drug developer Cambrex struck a deal to be acquired by the private equity firm Permira Funds for more than $2 billion. Cambrex says under the agreement, its shareholders will receive $60 in cash for each share. Cambrex surged more than 47% to $60 even. Teva Pharmaceuticals posted better than expected earnings and revenue and reaffirmed its full-year profit forecast. The drug maker also said its CFO will be leaving due to personal reasons. The stock was up more than 3% to $7.29. FedEx is ending its ground delivery services with Amazon. This comes as FedEx already ended its air shipping contract with Amazon in the U.S., but will still deliver international shipments. FedEx shares were down a fraction to $160.66. Amazon was up a fraction to $1,793.40. After the bell, Roku reported better than expected results thanks to an increase in active user accounts. The video streaming company also raised its full-year outlook. Shares initially rose in after-hours trading, and they closed the regular session up more than 2% to 197. Also after the bell, Lyft posted a smaller than expected loss and a beat on revenue targets thanks to more riders as well as easing price competition with its rival Uber. The company also raised its full-year guidance. Shares initially rose in after-hours trading. They closed the regular session up more than 2% to 60.29. Coming up, hidden threats.
What look like basic devices all over your office can be hacked in ways you'll never believe. That's all coming up.
Here's a look at what to watch for on Thursday. We get a snapshot of the labor market with the release of weekly jobless claims numbers. With currency issues front and center, wholesale inventories for June is something to watch for. A higher than expected reading would be bearish for the dollar. And another area in focus is energy, so keep an eye on the natural gas storage numbers. That's what to watch for tomorrow. And finally tonight, the phone in your office, the industrial fan system in a lab, the printer. All of these devices contain tiny computers that can be hacked and used to gain sensitive business data or cause damage to networks. Cybersecurity pros say more needs to be done to keep these devices secure. And now some manufacturers are listening and making security a competitive advantage. Andrea Day has our investigation, hiding in plain sight.
No demo is complete until we've tried to physically destroy the device.
When you interview this CEO, you may wind up evacuating.
All right, let's get out of here. All right,
let's get out of here. Ong Sui founded the cybersecurity firm Red Balloon here in New York City.
This is where the magic happens.
This is where the magic happens.
And here, the goal is to make embedded devices more secure. And that means breaking in, taking them apart, and exposing flaws.
Yes! 100% of these devices can be compromised in some way.
100%.
100%.
Embedded devices are like mini computers. Inside almost everything you can power up. From smart home devices to medical gear and cars. At every financial exchange, power plant, air traffic control, and almost every company in the world.
This is probably the most important cybersecurity threat that we have today because these computers control every single aspect of our critical infrastructure that we depend on every single day.
And according to a report by market research firm Radian Insights, the global embedded system market is projected to be worth $214 billion by next year. This is a small version of an air filtration system that's in a lab the team's working with right now.
You don't want the dirty air to come out ever, and this computer will allow that to happen.
They hack devices inside the fan's controller, not only forcing the dirty air in the wrong direction, but ultimately shutting it down. And it goes up in smoke.
That's awesome.
But Sui says the issue goes way beyond this demo. The team recently uncovered a major vulnerability in more than 100 devices made by Cisco, the largest manufacturer of network equipment. According to Red Balloon, we're talking about a potential attack that could sell for millions. They let Cisco know what they had found, and the company published this critical advisory. Cisco turned down a request for an on-camera interview, instead releasing a statement saying in part, Cisco is committed to transparency and is not aware of any malicious use of the vulnerability that is described in this advisory. Cisco will release fixes for this vulnerability. We wanted to find out what other industry leaders are doing to protect their embedded devices and reached out to HP and Huawei. Both companies were not part of Red Balloon's findings. HP is the largest manufacturer of printers, which contain embedded devices. Andy Rhodes is the global head of HP's commercial PC business. His company's advertising claims to have the world's most secure printers.
We put this special code into the printer so that it's always looking for malware and devices.
Huawei did not agree to an interview or provide comment.
And back to the Cisco findings. We asked the company if a tool exists right now to know if a device has been hacked. Cisco telling us in part, an audit tool is not currently available. We recommend customers review the security advisory to assess the best way to protect their network. I'm Andrea Day for Nightly Business Report.
And before we go, let's take a look at the day's final numbers from Wall Street. It was a wild one. The Dow finished down 22 points to 26,007, but it had been down nearly 600. The Nasdaq rose 29 and the S&P 500 climbed 2. The index's 2% reversal was its biggest comeback of 2019. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us. Have a great evening. We'll see you right back here tomorrow.